The company that promised to revolutionize the way we buy cars and make it as easy as grabbing a Snickers bar from a vending machine. But wait a minute, is Carvana just a pipe dream? Or did the pandemic really sink this ship? Carvana was once seen as the future of car buying, with the stock price skyrocketing from $29.35 to $360.98 in just a few months. I mean, who wouldn't want to buy a car from a vending machine, right? But just when Carvana was hitting the top of its game, the pandemic hit, and dealerships across the country shut down. And just like that, the dream was over. Carvana's stock price plummeted, and the company is now on the verge of bankruptcy. So in this video, we'll be exploring what went wrong for Carvana and how it went from being a rising star to the brink of collapse. And for those of you who are considering buying a car from them, we'll be discussing how this affects you. So buckle up, it's time to find out what's going on with Carvana. Imagine this, you're driving down the highway and you spot a vending machine for cars. That's right, a vending machine for cars. I mean, it's one of those crazy business ideas that you hear about and you're like, no way, that can't be real. But it was real, and it was a real good one. Launched in March 2013 in Atlanta, Carvana has been making waves with its innovative approach to car buying. With tens of thousands of cars available online, customers are able to find, tour, and buy their dream rides all from the comfort of their own homes. And the perks don't stop there. With Carvana, you're looking at prices about $1,000 lower than your average dealership, all without having to haggle with salespeople. Plus, with the option to finance and sign up for warranties online, you can have your car delivered straight to your door or even pick it up from one of their fully automated car vending machines. It's like a giant futuristic vending machines for cars. How cool is that? But, as they say, there's always a catch. Carvana's business model may be convenient for the customer, but it certainly complicates operations. From inspections and recalls to maintenance and deliveries, there's a lot more that goes into flipping a car than meets the eye. And let's not forget, Carvana's goal is to do everything better than CarMax, which is a pretty tall order. With a $225 million initial public offering in April of 2017, Carvana became a public company, and there was a lot of excitement surrounding the event. However, the stock price took a 14% hit at the end of the first day of trading. But it looked like up was the only way to go, and that they did. Just 9 years after its founding, Carvana became one of the youngest companies to make the Fortune 500 list, right alongside heavyweights like Google and Amazon. But it took a minute for Carvana to start seeing green. Even though Carvana sold over 425,000 vehicles in 2021, making it the second largest used car retailer after CarMax. See, Carvana's problem isn't becoming profitable, it was staying profitable. In Q2 2022, despite selling a whopping 117,564 cars, Carvana still posted a $439 million loss. It had investors scratching their heads and asking, is this model just not sustainable? Now, I know what you're thinking. It took Tesla 17 years to earn its first profit, so what's Carvana's story? Well, it took them almost 10 years to turn a profit, but by late summer 2021, the CEO was in a celebratory mood after Carvana hit its first profitable quarter. And by January 2022, Carvana celebrated selling its millionth car. But here's the thing, folks. Carvana's success was a perfect storm of circumstances. The pandemic caused supply chain issues and shut down the production of new vehicles. Social distancing measures made Carvana's online car buying experience a lifesaver. Government stimulus programs gave customers extra cash to spend, and low interest rates made buying a car more attractive than ever. But as they say, be careful what you wish for. Carvana's sky-high demand became their downfall. All that demand was just too hot to handle. Carvana couldn't keep up with the flow of vehicles coming in and going out. So what do? They went on a buying spree. Basically, in an attempt to keep up with the demand and expand its footprint, Carvana made a massive all-cash deal and purchased ADESA and its 56 auction locations across the US for a whopping $2.2 billion in May 2022. Unfortunately, things started to go downhill from there. The demand suddenly dropped like a lead balloon, and Carvana is left with a massive inventory and a record low in Q3 sales. Investors were starting to get jittery, and creditors were concerned. It's like they built a castle in the sky but forgot to check if it was built on solid ground. And if that wasn't enough, Carvana had a habit of forgetting to send the titles to their customers' cars. You can imagine the chaos that caused. Which was a big problem because without the title, you can't legally drive your new ride. Enough customers complained, and Carvana's dealer license got suspended in North Carolina, Florida, Michigan, and Illinois. But apparently, the states of Florida and North Carolina have given Carvana a bit of a break. But Michigan, oh boy, they weren't having any of it. The state's Department of Motor Vehicles found Carvana in a sticky situation with missing vehicle titles, fraudulent activities, destroyed documents, and more. As a result, Carvana is still banned from selling cars in Michigan and even tried to file a restraining order against Secretary of State Jocelyn Benson, but to no avail. But don't worry, some experts still believe Carvana still has a chance of bouncing back. However, the big question remains: can Carvana get back to profitability and pay off its debt load? Bank of America certainly has its doubts, downgrading Carvana to neutral and warning that without a cash injection, Carvana may run out of cash by 2023. And oh boy, did Carvana stock take a hit, plummeting 97% from its all-time high of $376.83 per share to just $4. Analysts are split on whether Carvana will be able to bounce back from this bumpy road. Some believe that Carvana will recover, but they might have to take it down a notch in terms of growth goals. But on Wednesday the 8th, the stock hit the gas and shot up 24%. It was like a rocket on wheels, but then suddenly hit the brakes and lost some of its gains. So what's behind this wild ride? Is Carvana the latest addition to the meme stock club along with GameStop and others? These stocks skyrocket on a surge of online hype. But wait a minute, if that were the case, then how do you explain the Goldman Sachs getting behind the wheel? They increased their ownership in Carvana from 5.3% to 8.3% in their latest filing. Looks like they're taking a road trip with Carvana, and they're not afraid of a little turbulence. Carvana stock is a roller coaster right now. Trading was almost temporarily stopped at a point. Let me just say, if you're in the market for a new ride, you might want to steer clear of Carvana for now. I'm talking about putting the pedal to the metal and getting out of there faster than a NASCAR driver. Why, you ask? It all stems from the little thing called a title. You know, that piece of paper that proves you're the legal owner of your shiny new ride. Unfortunately, some Carvana customers have been waiting for their titles for 11 months and counting. Can you imagine waiting that long just to legally drive your new car? No, thank you. So, where do we see Carvana in the next 10 years? And are they just a one-hit wonder riding on the meme wave, or are they here to stay? Personally, I think they're still in the game, but they've got some serious obstacles to overcome. They need to get those customer complaints sorted out and get those titles in the hands of the rightful owners. What do you think? Will Carvana rise above their current legal struggles, or will they fade into the background? Let us know your thoughts in the comments section below.